welcome to Flip Capital UK's second webinar of the year. Today we'll be discussing central bank policy and its impact on the financial markets with Wayne Bishop, a ethical fund manager for King Shaxson, who has over 25 years experience in the financial sector and is currently responsible for around 60 million AUM. Thanks for joining us today, Wayne.
You're welcome, Andy.
Thank you. Throughout the webinar, the question box is available on the right-hand side of your screen. So if you have any questions, please reach out to our support team, who will get back to you. Also, just to give you a brief outline of today's webinar, we'll be discussing the US Federal Reserve, looking at the challenges ahead for Jerome Powell, before moving on to the super dove Draghi and the ECB, and finally concluding on the Bank of England. Right, so let's get started. So, with Jerome Powell being sworn in just a few weeks back, how do you think he can turn around the fortunes of the dollar? We're just going to pull up the dollar-yen graph now for you guys at home.
Obviously, a lot of things in America are right now a big mix between politics and economics. So we've had the big tax changes, which have really brought in a large stimulus to the US economy. And what this does is it's very clear to everyone that the US economy is on the up and that the economy is going to grow and it is going to grow well. And to a large extent, we are quite clear on the course of US rates. There was perhaps a little bit of an increase in the expectations about the size of the tax package. We're now, if you were reading today the Wall Street Journal, for example, we're now debating whether you're going to have 3 hikes this year or 4 hikes this year, and whether you've got 2 hikes next year, which means you're looking at US dollar short rates ending up sort of 2.75 to 3%. At some stage this year, with inflation, that could go. You could actually start getting positive yields out of the US. The thing is that this is all very much in the market. We know about this, and the debate really is on the fine points of 3 or 4 this year. Really, the problem with the dollar is we know exactly what's happening in America. What is a little bit more difficult is Europe and Japan, obviously the 2 other big counterweight currencies, where we're a little bit uncertain there. So really, the fate of the US dollar, there isn't a great deal that Powell can do. He could talk a little bit more hawkishly. The problem with talking more hawkishly is that people are also beginning to price in the time there will be a recession. Partly by nature of tax reforms is it's a big boost now and it's a cost later, and therefore people are beginning to worry that yes, we're doing well now, but then in 2020 we might start seeing a recession. Therefore, you might start seeing people price in sinking rates really from 2020. So it's going to be a bit counterproductive for him to get too hawkish, but at the same time, really now we need to see something out of Europe, we need to see something out of Japan to really understand the course of their economy, because that I think is going to have a bigger impact on the dollar than the US alone.
Thank you, Wayne. You hinted in your answer there about inflation. Speaking about inflation, the core PCE remains persistently below target. Do you see this improving in either the short or long term? And on that, how do you see the recent slump in oil affecting this? We're going to bring up an oil graph for you guys now.
Okay, well, yeah, core PCE is really quite a big problem here, because the oil price, I think, is naturally going to be capped because of the growth of shale. This has been such a game changer. I think people are really still only getting to grips with this. If the price rises, America just turns on more and more tax. And therefore, really, despite every effort to get a high price, and I think there has been an effort, particularly with the flotation of Saudi Aramco coming up, to raise the oil price again. Every time it rallies, I think you'll start to see increased supply and it will start to come down. And of course, we're talking about peak oil in the longer term. So I think the core number is quite difficult. The other aspect of core, of course, is food. And if you look at the charts out the wheat chart or the corn charts recently, food prices have been under a lot of pressure as well. So you've had years and years and years of bumper harvest. So you're not seeing any pressure in food, you're not seeing any pressure in oil. And therefore, I think the core is going to find it very difficult to rise. That said, we did have an oil price, we did see quite a sharp rise in oil last year. That's obviously fed through into the core numbers, but should now start to feed through into non-core numbers. What do I mean by that? Well, anything that, anything directly affected by oil obviously is a direct impact, is in the core number. or is in the core number. Anything that basically then is a follow-on effect of the increase in food prices, the increase in delivery costs, because the oil price gets reflected through into the raw material costs, then sort of seeps its way into inflation. So at the moment we're seeing that remain reasonably firm because we had the higher oil price last year. As we get a sinking oil price again, you may see that come under pressure as well. I don't think inflation is really going to be a driving force in America. If it does, it's going to have to come through the form of wages, and that is possibly about the only place where you're going to see inflationary pressures begin to build up. But again, I think there's increases in productivity. So inflation to me is not going to be a huge problem in America.
Thanks, Wayne. Moving on, the US stocks experienced sharp slumps recently, with the Dow Jones losing over 1,000 points in a day. Do you believe that the equity sell-off heightened on increasing concerns that inflation will push interest rates higher, or not?
I think that was very much the go-to excuse or the go-to reason when people were looking for a reason why did the US market collapse so rapidly. I think it was really an afterthought or a reason, really. I think the main problem you had with the US market was that really it went far too high in January. It was driven hard, particularly by ETF and index-linked products and leverage products. And then immediately, the moment there was no demand, there was nothing left and it came down. You've had one of the biggest problems with the change in regulation over, say, the last 10 years that people are still getting to grips with. Banks' balance sheets have been shrunk, their trading books are shrunk, so therefore the banks are able to be less of a shock absorber when markets move because dealers don't have as much to play with or as much to use. At the same time, the end investor has access to highly liquid and highly leveraged products that they never had access to before. Therefore, the end user can drive the market much more rapidly up and down, and there is less of a shock absorber now in the market end of liquidity to absorb it. And I think what we saw there was a classic case of everybody going up at the same time, everybody trying to find the exit at the same time, and going up a hill and down a cliff very rapidly. In the big picture, of course, it's really been nothing more than a storm in a teacup, but I would expect more volatile days like this to come. But I think we were just searching for excuses when we were trying to say it was about interest rates. Yes, rising bond yields have become a concern, but really these numbers are not massive in the big picture. I think this was more about liquidity.
Okay. Last time out, you predicted that Trump would do something on fiscal policy, with you suggesting it may not be to everyone's liking. With Trump's sweeping tax reform now coming into effect, how do you see this materialising? And do you believe this will be positive or a negative for the Fed?
Forgive me, sorry. There's definitely a big psychological effect with these tax reforms, and there's also a very big technical effect with the tax reforms. And these are both going to boost GDP or growth in the short term. What do I mean? Well, everybody feels better, and what we've seen is companies sending money out of their balance sheets into mainstream. A lot of these tax cuts are being sent to employees directly. They're able to consume, reduce debt, or do something with it, which I think is a big positive. The other thing, of course, is that more companies will now be routing their sales through America rather than through Ireland or the Netherlands or Luxembourg, for example. So it's going to make US productivity or US GDP look a lot better without actually changing anything, because it's actually going to be technical. So you're going to see a technical improvement, you're going to see a psychological improvement, and I think for the next 12 months, this is going to be quite significant. Things are going to look very good. And I do think that there's a bit of timing here in the midterm elections. After that, the bill comes, and I think we'll start to see, what a lot of people have been saying, oh, it's bad really in the long term. Some of that truth will start to come to bear. The question is whether the US economy is picked up sufficiently in the short term that people don't really mind in a year's time or aren't bothered, or whether in a year's time we're going to start to see a bit of a slump. But the fact of the matter is, it's had a very good short-term effect, and I think that's quite a strong short-term effect. And that's going to drive the market well. So I think he's done a very good political job. Whether people like him or not, that's beside the point. Politically, he's been quite shrewd with these moves here. The bill comes next year, and I think the hope, if you like, for those looking for a stronger US economy is that by the time the bill comes, people are too happy to care or pay the bill.
Yeah.
And I think he may just get away with it.
Yeah, so sort of a clever move there by Trump with a view to the midterms. Right, finally on the Fed, how do you see the Federal Reserve's proposed rate hikes playing out? Market analysts are predicting between sort of 3 and 4 hikes this year. Do you preempt any issues with this already being priced into the market, or is that sort of to be expected?
Yeah, the exciting discussion is it going to be 3 or is it going to be 4 this year? I think at the moment, with the strength increasing, they would probably try to get away with 4 rather than 3. But again, it is already to a large extent priced in. And if we do suddenly look like we're going to head to 4, then also we'll start saying 5. I think we still feel the end game is sort of round about the 3% area. The big other that's going on in the background, of course, that's really sort of gone very quiet is the Fed is still reducing its balance sheet. And obviously, at the moment, we haven't really seen many effects. We know about it, it's happening, it's going on in the background. Slowly, that will begin to bite more and more, perhaps into the second half of this year and into next year, we'll start to see some effects on that. So I think there may be room for more caution, but at the moment, I think the course is well telegraphed. I think markets are really in a very luxurious position of having every slightest detail telegraphed very, very clearly. So I don't see any particular reason for them to change that. If we do suddenly find that we're a little bit quicker on the hikes and suddenly some people start jumping at 5, we may see a little bit of nervousness in the market. But I genuinely feel I think 4 is pretty well priced in and people are comfortable.